It is Tuesday, December 23rd, 2025, and the global silver market has just crossed a line of no return. As I speak to you right now, the price of silver is sitting at $70.61. This is not just a number on a chart. It is a declaration of war against the paper establishment. If you have been waiting for a dip to buy, you are looking at the wrong map. The floor has moved. The psychological barrier of $70 has not just been broken, it has been fortified. For years, the mainstream financial media told you that silver was a relic, a volatile commodity that would never regain its former glory. They used the massive paper leverage in New York and London to suppress every rally. But today, the mechanism of suppression is failing. At $70.61, every single short position held by the major bullion banks is bleeding. They are no longer in control of the price. They are in a fight for their lives. But the real story is not happening in New York. While the West struggles to understand why their paper sales are no longer working, the Shanghai Gold Exchange is printing premiums that scream of a physical vacuum. We are watching the birth of a dual price system. One price for the digital illusion in the West, and a much higher, much more honest price for the physical reality in the East. Tomorrow, the test intensifies. If $70.61 is the floor today, then $73 is the target for the next 12 hours. In this extended analysis, I'm going to break down the mathematics of this collapse. I will show you why the $70 mark is the point of terminal velocity for the shorts. We are going to look at the data that the banks do not want you to see, and I will explain why this move to $73 will be the final nail in the coffin for Western price discovery. Let us strip away the noise and look at the cold, hard facts of the silver revolution. To understand why $70.61 is such a dangerous number for the banking elite, we have to look at the death of the arbitrage bridge. In a normal, healthy market, global prices stay glued together because traders move metal to where the price is highest. But that bridge is now a ruin. Tonight, the premium in Shanghai is expanding, even as the global price rises. Usually, a rising price encourages sellers to bring more metal to the market, which should narrow the premium. But that is not happening. Why? Because there is no metal left to bring. The arbitrageurs who usually make risk-free profits by buying in the West and selling in the East have hit a wall. They cannot find the physical bars in the size required to satisfy the hunger of the Chinese market. When arbitrage breaks, the market loses its global equilibrium. It becomes a localized fight for survival. At $70.61, the Western paper market is trying to tell the world that silver is still available. But the physical market in Shanghai is laughing at that price. They are bidding $5, $6, or $7 above the Comex spot price because they know that a paper contract cannot be melted down to make a semiconductor or a silver paste for a solar cell. This disconnect is the ultimate proof of a broken system. If the West had the metal, the premium would disappear in an hour. The fact that it persists as we trade above $70 tells you that the vaults in London and New York are either empty or the metal inside them is already double and triple counted. We are entering the phase of the squeeze where the paper price must chase the physical price or risk becoming completely irrelevant. When $73 prints in Shanghai tomorrow, the Western markets will be forced to either follow the move or admit that their paper exchange no longer represents the real world. To find the truth in this market, you have to look past the headlines and dive into the vault data. While the price sits at $70.61, the underlying infrastructure of the Western exchanges is rotting away. We must talk about the distinction between eligible and registered silver. Eligible silver is metal sitting in a vault that belongs to someone else. Registered silver is the only metal available to satisfy delivery on the exchange. As of tonight, the registered silver inventory at the Comex is at a 30-year low. We are seeing a consistent month-over-month drawdown that has removed tens of millions of ounces from the system. This is not a temporary fluctuation. It is a structural drain. The banks are desperate to convince you that there is plenty of silver, but their own data tells a different story. If everyone who held a paper contract for silver asked for their metal at the same time, the exchange would fail instantly. There is simply not enough physical metal to go around. At $70.61, the incentive to pull metal out of the vaults has reached an all-time high. Large investors and industrial users are realizing that the only way to guarantee they have silver is to take physical possession. This creates a death spiral for the shorts. Every ounce of silver that leaves the registered vault is an ounce that cannot be used to suppress the price. When you combine the record low inventories in New York with the massive premiums in Shanghai, you see the outlines of a global squeeze. The silver is not just being sold, it is being moved from west to east. It is being moved from the hands of speculators into the hands of people who intend to use it. This is why the $73 target is so significant. It represents the point where the remaining registered silver will be locked away, and the paper market will find itself staring into an empty vault. The second engine driving us towards $73 is the industrial black hole. For decades, silver was seen primarily as a precious metal, a cousin to gold. But in 2025, silver is the indispensable backbone of the modern technological age. We are no longer just talking about jewelry and coins, we are talking about the survival of the global tech economy. The explosion of artificial intelligence has created a massive new demand for high-end semiconductors and data centers. Silver is the most conductive metal on the planet, and there is no substitute for it in high-performance computing. At the same time, the global transition to renewable energy is accelerating. Solar panel production is consuming a record percentage of the annual silver mine supply. Every gigawatt of solar capacity added to the grid requires millions of ounces of silver. Look at the behavior of the procurement managers in Asia. They are not watching the technical charts. They are not waiting for a moving average crossover. They are looking at their production schedules. If they do not have silver, their billion-dollar factories stop. This is what we call inelastic demand. When a solar company needs silver to fulfill a contract, they will pay $70, $75, or $80 without hesitation. The industrial sector is now competing with the investment sector for a shrinking pie of physical metal. This competition is happening in an environment where mine production is stagnant or declining. We have had a structural silver deficit for several years, and we have reached the point where the above-ground stockpiles can no longer bridge the gap. At $70.61, the industrial users have realized that the silver market is in a permanent deficit. They are front-loading their purchases, and that panic buying is the fuel that will rocket Shanghai to $73 by tomorrow morning. We have established the foundation of this crisis. Now, we must look at the 7 specific triggers that are acting as a detonator for the $73 price point. These are the moving parts that will collide in the next few hours as the Asian session takes the lead. Trigger number 1 is the massive wave of margin calls. As the price holds at $70.61, the short positions held by commercial banks are underwater by billions of dollars. When the exchanges raise margins to account for this volatility, the shorts will be forced to either provide more collateral or buy back their contracts. Buying back a short position is a purchase, and in a thin market, this creates an upward spike that feeds on itself. Trigger number 2 is the sudden shift in the gold to silver ratio. For too long, silver has been undervalued relative to gold. But as gold reaches new all-time highs, investors are rotating into silver, seeking the higher percentage gains that silver offers during a bull run. This rotation is adding massive investment demand to an already strained industrial market. Trigger number 3 is the potential for export bans. We are hearing whispers that several silver-producing nations are considering restricting exports to protect their own domestic industries. If a major producer like Mexico or Peru even hints at an export tax or a quota, the price will not just rise, it will gap up by $5 in a single session. Trigger number 4 is the breakdown of the London OTC market. Most silver trading happens behind closed doors in London, away from the public eye. But when the physical spread in Shanghai hits $7, the private players in London can no longer settle their trades in cash. They will demand the metal, and the London vaults are not prepared for a sudden run. Trigger number 5 is the acceleration of solar panel manufacturing in China. The latest production data shows a vertical increase in silver paste consumption. These factories are not price sensitive. They are the primary reason for the persistent Shanghai premium. Trigger number 6 is the psychological flip. At $70.61, the bears have lost the narrative. Every time the price has dipped in the last 48 hours, it has been aggressively bought. This tells us that the market has accepted $70 as the new normal. Trigger number 7 is the technical breakout. On the long-term charts, $70 was the final resistance. With that barrier gone, there is a vacuum of sell orders between here and $80. $73 is simply the first stop in a much larger move. What we are witnessing is not just a bull market in a commodity. It is a geopolitical reset. For a century, the West has used the paper markets to dictate the price of the world's natural resources. They used the dollar and the Comex to ensure that the real wealth of the planet was kept artificially cheap. But that era is over. The BRICS nations and the East have realized that he who owns the physical assets makes the rules. By allowing the price of silver to rise in Shanghai while the West tries to suppress it, China is effectively devaluing the paper dollar relative to real assets. They are creating a new silver standard, not by official decree, but by market dominance. Silver is becoming a strategic reserve asset. In a world of digital currencies and infinite debt, silver represents a form of honest money that cannot be printed and cannot be cancelled. When Shanghai prints $73 tomorrow, it will be a signal to every central bank in the world that the Western pricing mechanism is no longer the gold standard of truth. The East is hungry for silver because they are building the future. They are building the infrastructure of AI, the energy grids of the 21st century, and a financial system backed by tangible reality. The West is stuck in a loop of paper manipulation and debt expansion. This disconnect cannot last forever. The $70 floor is the line in the sand. It marks the moment where the East stopped following and started leading. Silver is the first domino to fall in the collapse of the paper empire. We have covered a vast landscape tonight, from the historical echoes of Roman debasement to the modern-day collapse of the arbitrage bridge between New York and Shanghai. At $70.61, the evidence is undeniable. We are no longer waiting for a breakout. We are living through one. So, what is the plan for the next 48 hours as we eye the $73 target? First, you must ignore the mainstream headlines that will inevitably call this a bubble. A bubble is characterized by excess supply and irrational exuberance. What we are seeing is the exact opposite. It is a market characterized by physical scarcity, record low inventories, and desperate industrial buyers. This is not a bubble. It is a repricing of a suppressed asset to its true value. Second, you must watch the behavior of the Western banks very closely tomorrow. If the price in Shanghai hits $73 and the Comex tries to sell off to $65, do not panic. That widening gap is the sound of the system breaking. It is the moment the paper market admits it has no silver left to deliver. In that scenario, the physical price is the only one that matters. If you own physical metal, you are the house. If you own a paper contract, you are just a guest in a casino that is running out of chips. Third, understand that silver is the leading indicator for the broader market. When silver moves this violently, gold is usually not far behind. We are entering a period of extreme volatility where the old rules of 60-40 portfolios and fiat stability are being incinerated. Your goal is not just to make a profit in paper dollars. Your goal is to protect your purchasing power by holding assets that the government cannot print and the banks cannot manipulate. The bottom line is this. Tuesday is the day the world wakes up to the reality that the West has lost control of the silver price. $70.61 was the warning. $73 is the confirmation. And once that confirmation is official, the race for the remaining physical silver will become a global scramble. The Asian session opens in just a few hours. The world is watching, the shorts are trapped, and for the first time in history, the truth is being told in Shanghai. Stay disciplined, stay informed, and do not let the noise of the dying paper system distract you from the physical reality unfolding before your eyes. We are witnessing the end of an era and the beginning of a new silver standard. Make sure you are on the right side of the vault door.